Welcome to Making Chips. So we've got this big, one big beautiful bill everybody's talking about, and I wanted to get some thoughts out on it, but I couldn't do that without talking to our friends over at Clifton Larson Allen. So today I've got Steve Combs and Susan joining me. Thank you guys for being here.
Our pleasure. Thank you.
You guys are I'm sure you have dug in and read all of this bill and probably just understand it all completely first time read, right?
Oh, yeah.
Yeah, just right out of the gate.
900 pages, just absorbed.
Right. Yeah, so my listeners, are pretty familiar with Clifton Larson Allen. You guys are a great firm, very, very involved in the manufacturing industry. But why don't both of you introduce yourself? Susan, let's start with you.
Okay, great. Thank you. Hello, everyone. I am Susan Roberts, and I am the Managing Principal of Growth for Tax for CLA. And my entire career has been spent doing tax planning, tax avoidance, not to be confused with tax evasion, avoidance, and working with manufacturers. So I am honored and thrilled to be here. So thank you.
Yes, thank you, Susan. Steve, how about you?
Hello, everyone. Steve Combs, tax principal with CLA. And like Susan, been involved in manufacturing my entire career, which is now just past 25 years. So with the compliance portion, definitely the planning, anything related to manufacturers. And with bills like this, there's always something for us to do with our clients on the planning side. So appreciate the invitation, Mike, and happy to be here today.
Yeah, so I think anybody that owns a business has, been following along the headlines of the one big beautiful bill. And, there's a lot of positive and negative out there. There's a lot in it I had read some things, I don't know, I guess it must have been last week that I had no idea that they were covering some of the stuff they were covering, not anything related to manufacturing or anything, but just, so there's a lot there and there's a lot to unpack. And as business owners and business leaders, a lot of it can affect our decisions on our, maybe anything from our growth or our lack thereof, or, if we're planning an exit from our company. There's obviously tons of incentives and tax programs, but there's workforce funding and grants and all sorts of stuff tied to this, right? And correct me if I'm wrong, but I think a lot of this is to push towards the reshoring and all those efforts that have been going on under the current administration and workforce training and bringing a lot of that back.
Yeah.
So with that said, so let's let you guys talk to me like I'm me. I'm a I own a manufacturing facility in Oklahoma. I've got 74 employees. I do a bunch of CNC precision manufacturing, and then also welding and fabrication. We offer turnkey solutions out to the market. I think we look a lot like a lot of our customers, right? We're hiring people, making parts for other people. We need people, we need equipment, we need training. There's all sorts of advanced manufacturing technology on the market today. All of these things are just showing up in our visions every day. How does this bill affect any of that? Where do we want to start?
Well, I'll jump in real quick and tell you, Mike, that you've hit on a lot of truths there. There are a number of things in this act. So now it's called the One Big Beautiful Bill Act, and some people around here, which really cracks me up, we're calling it OBBA. OBBA. So it just cracks me up. But there's a lot of stuff in this act that is actually, I'm going to call it informational. And then there's a lot of information in this act that I'm going to call it actionable. And the difference between those two is that you may remember back 2017, 2018, we got the Tax Cuts and Jobs Act. That was under President Trump's first administration. There were an awful lot of things in this particular act that simply extended the things from that act, which means we have been doing those the way that act laid it out, but they were set to expire, or what in tax we call sunset, at the end of this year. And a lot of those have now been permanently extended. And I want to be careful with that because in tax, the word permanent only means until we get a new act.
Right. Right.
There's nothing permanent.
It's
But
temporarily permanent.
it's you couldn't have said it better. It's temporarily
Right.
permanent. So we do have a number of provisions that you will do it in 25 and in 26 exactly as you did it in 24 and 23, but it is new as part of the act in that it was extended. So we've got that bucket. Then we have a bucket of what Steve and I would call actionable items. And those are items that are actually genuinely new or brushed off and refreshed. And those are things where I think it's important to act, and especially the ones that are placed that are effective either 1/1 of 25, or there's a few provisions that are effective as of the date that Trump took office, which is 1/19 of 25. So those are the ones, those provisions are the ones where we want to look backwards and forwards for this year and take action. And then some of them may be effective 1/1 of 26 and so forth, where we can also do planning. So I think that kind of sets us up. And as we kind of walk through this, maybe Steve and I can give direction as to whether this is kind of more of the same or more informational versus actionable. Does that
I
set
think
it up?
that would be incredibly helpful because I know, most of us are always trying to, be tax efficient. So if it's some of this stuff that we've been doing, that'll be good to hear that it's not necessarily anything new.
Yep.
You may or may not continue doing that, but it's something you've probably already talked about. So
Absolutely.
that's good.
Well, so should we jump in with one of the actionable items, and I could talk about one, then I can hand it over to Steve to maybe talk about one. Would that make sense?
I think that'd be perfect.
Sounds good.
Okay, perfect. So I'll start with one that that was retroactive to 1/1 of 25, which has to do with bonus depreciation. So our listeners may be thinking, Susan, bonus depreciation is not new, and they are correct. We had bonus depreciation. It's been anywhere from, when I started my career, there was no such thing as bonus depreciation. And then we got it, and it's been anywhere from 100% down to, say, 40%. So under the Tax Cuts and Jobs Act, bonus depreciation started phasing out. So it was at 100%. It went to 80. It went to 60. It was going to 40%. And what bonus depreciation is, just to level set, what that means is when you buy an asset like a desk that I'm sitting at right now or a machine for your manufacturing floor, the IRS assigns a life to that asset. So they say that machine right there, we think it has a 5-year life. So even though you're paying $300,000 for it right now today, and maybe that's through cash or through debt, you still have to write that asset off over 5 years. Let's say. Same with a building. If you build or buy a new plant, you have to write that stuff off over the deemed life that the IRS gives you, even though you're out of pocket for the money today. So bonus depreciation came in as an injection into the economy to allow people to write off 100% of the cost of whatever it is that they bought, assuming it qualifies. So the biggest item right now that we're really excited about is actually buildings and even equipment.
Sure.
So we have now gotten 100% bonus depreciation reinstated, effective 1/1 of 25, retrospectively, meaning we can write off 100% of qualifying property that we buy. So if you are thinking about getting a new piece of equipment, if you are thinking about adding on to your facility, these kinds of things, now is the time to do that. We have 100% bonus depreciation, especially if you're in an income situation. And if you have recently purchased a building, let's say you purchased a building in the last 3 years or built one, we can now use these new provisions to do something called a cost segregation study, where we chunk that building up into its components and write them off quicker.
Right.
So when you buy a building, the IRS would tell you that's a 39-year asset, and they would say you have to depreciate it over 39 years. But a cost segregation study allows us to chunk it up by its components. So electricity, for example, might be 5 year, other components 7 years, 10 years, 15 years. And you get to take those buckets of costs in each of those lives and write a lot of them off right now, today, in full. So that is something where, again, if you've built a building or purchased a building in the last 2 or 3 years, and even if you did a cost segregation study then, now we have a real opportunity to do that again and recapture a lot of costs.
So, a couple questions on the bonus depreciation. Is it scheduled to decrease again like it did from the previous act?
I believe it is now permanent.
Okay. So,
Sorry, one thing to jump in is the effective date is 1/19/25, the day that Trump took office.
okay.
Thank
So
you.
that there's a couple weeks there that maybe it doesn't qualify, and that would still
Okay.
have the 40% currently.
Okay.
And I'll say this too, that date is the placed in service date. So even if you bought it between 1/1 and 1/19, if you didn't place it in service until 1/20, it would still qualify. But okay, thank you for that, Steve. That's great.
So, second question, let's go to the machine example. If I bought a $300,000 machine last year and when I could only claim 40%, so I still now have 60% of the value on the books, right? Can I now take that full? No, because the date of service was last year. Okay.
Correct.
Okay. So same way with a bill, any of the assets, like they're just going to continue on the path they were when they were put into service.
Not for a building. So a building is different. That is true for equipment, that if you bought it in 24, you are stuck with those rules. But when you have a building, you can do that thing that we talked about called a cost segregation study.
Yeah, right.
Which is
Then
actually,
you'd put
it
the
allows you
different
to go
buckets out.
backwards. Mhm.
Right.
Exactly.
So on that front, here's probably the additional piece of advice I'd put out there is, because I've already seen, of course, all your machine tool vendors and, your equipment, all your big asset purchases, your large capital investment vendors, they're already going, hey, take advantage of it now, which is smart if you need it.
If you need it.
But the fact that you just said it's now permanent doesn't mean I have to buy it this year. I can get that same thing next year. Right.
Correct.
So, that's one thing I've seen a lot of people talking about that just scares me, because I've seen so many people over the years, they buy equipment just to be able to take the deduction. And then I go into their shops and I see all this really nice equipment not in use, but that they bought because they
Get the
could
deduction.
They could get the deduction. And I just always like to caution people, like, don't let that be your only reason that you buy.
Yeah, don't let the tax tail wag the business dog. It's
Right.
got to make good business sense. And
Yeah.
if you buy something, you're spending 100 cents on the dollar.
Right.
And then you're getting back, if you're in the highest tax rate, 37 cents on the dollar. But having 100 cents on the dollar is better if you don't need the item that you're purchasing.
Right. Right. Or if you're, again, I like the idea. Now that it's permanent, that also is going to allow you, if you need it, you don't have to buy it now just because of this. You can still buy it next year when you do need it or something. So
That's right.
just something I think people should keep in mind. All right. So yeah, that's a doozy. That's the one I've seen most people talking about, is what that means to their growth plans and so forth. What else we got going on in this one big, beautiful act in the OBABA?
OBABA.
So one of the items that we had in the past that has been extended is the qualified business income deduction. So for manufacturers, it's a 20% deduction on your qualifying business income, which you're in a traded business of manufacturing, you're going to qualify. And there was some talk of that increasing to 23% in some of the earlier versions of the bill, but in the final version, they kept that deduction at 20% and made that permanent. So that ends up reducing your rate. If you're at the top rate of 37%, that 20% deduction ends up saving about 7%. So it reduces the overall rate for manufacturing taxpayers that have the income flowing through to an S Corp or partnership, reduces their tax rate on that manufacturing income to 30%.
Okay.
So that's a big win for manufacturers, is that stayed in place. it maybe not as big if it had increased to 23%, but 20% deduction on that income is
Yeah,
still a
sure.
7% savings.
Yeah.
And one thing I'll point out about that deduction that I love about it, usually to get a deduction, you have to reach into your pocket and spend money. Not on this. This is a freebie deduction. You keep all your pennies in your pocket, but you still get this deduction. You don't have to buy anything. It's basically a piece of tax-free income in essence.
And that's a 1/1/25?
That, yes, that just continues on. So there's
Just
really not an
continues
effective
on.
date because it was already in place. So it continues on.
And is it now permanent?
It's permanent.
Okay.
Yes. And this was put in place during Trump's first term, and it was put in place because he reduced the corporate rate from 34% down to 21%. And at that time, they wanted to give the pass-through owners a benefit also, so they reduced their rate by giving them this deduction.
Okay.
So it kind of comes to my second point of entity selection, right? So we have a lot of, I'm sure, listeners that are S corporations, partnerships, they're flow-through entities, but we should always look at least probably annually, look at the structure and see, is that structure the best, for the manufacturer? Because there is another code section 1202, which is for qualified small business stock, which if someone's looking to, exit the business in the near future, it allows an exclusion against the gain for federal tax purposes. An exclusion up to 100% of the gain can be excluded if they're a qualified small business entity. And that's only available for C corporations. And there is a new tax law. I mean, part of this new bill, it changes some of the specifics of that exclusion, because previously you had to hold the stock for 5 years. You had the value of the company at any point in time when stock was issued had to be 50 million or less. And now with this under this bill, they've increased that 50 million to 75 million. So
Oh,
the
wow.
valuation of the business can be up to 75 million when stock is issued, and that the term that you need to hold the stock is not necessarily 5 years now. Then they now allow partial exemption of 50% at 3 years, 75% at 4 years, or 100% exclusion if you hold the stock for 5 years.
Okay, so this episode is going to be right before my By the Numbers episodes that I actually recorded with a lot of your team at your connection center up in Minneapolis a few weeks ago. And a lot of that was focused around that 3 to 5 to 7, maybe 10-year planning to sell your business. So if you were in that phase of selling your business, if you're going to sell your business in the next 10 years, then everything you just said could be really appropriate to start thinking about. That be a fair statement?
Yes, definitely. And you
Yeah,
have there are some detriments to being a C Corp. You're
sure.
right. You have double taxation. So you need to really analyze to see if it's the best fit, not only for now, but also for when you sell. Because there could be a detriment, for the next 5 to 7 years before you sell by being a C
Right.
corporation compared to maybe an S Corp. But it may be worth it if you're saving 100% of the gain, when you sell in 5 to 7 years.
Well, and that's just one of those situations where I need to sit down with my advisors, whether that's on the sales side, the current tax side, whatever, call up Steve and say, okay, here's my plans. And I assume that you would help me walk through that and decide and look at, okay, well, you're going to pay this much more tax for the next 5 years, but when you sell, you're going to get this much better return.
Yes.
So
And
net, is it worth it?
as an example, I've been going through that process with one of my clients that has had large losses, the last 3 years, but they have some large contracts coming up. So they've been accumulating losses that they've been able to utilize on their personal return because those are
Sure.
flowing through in an S corporation. And we didn't want to convert to the C corporation too soon and then have those losses trapped inside the C corporation. So we've been doing some planning on kind of figuring out the timing, the best time to convert to the C corporation where they're still getting those losses, but the value doesn't exceed that $50 million. Because if they wait too long and they get the benefit of those contracts, the value, of the business increases. So this is something that we've discussed since they've passed it,
Sure.
which we're going to revisit and probably expedite converting to a C corporation soon.
Right. Okay, so I think another one that's going to affect the manufacturing pretty heavy is around the R&D
Oh,
credits.
yes.
Do you agree there?
Yeah, there's a lot there. So, um, I would think that probably your listeners are aware that recently, in the last, let's see here, for 22 and 23, I believe, if you performed research or experimental work, research and development, you had to capitalize those costs and then amortize them over either 5 years or 15 years. 15 if the research was done outside of the US, and 5 if it was done inside the US. And so, Mike, kind of the way you kicked us off talking about reshoring, this is one of those where there's certainly an encouragement built into the new act for reshoring, because we have finally gotten relief on research and experimental costs that are paid for and performed in the US.
Okay.
If you are paying someone outside of the US to do that work, you still have to capitalize it and amortize it over 15 years.
Okay.
But if you have engineers on staff, that's one of the things we look for. Typically, if you have engineers, you're probably doing some kind of research or development or experimentation.
Right.
Then we can now write that off effective immediately. You no longer have to capitalize it. Now, you may be thinking, or I would be if I owned a manufacturing company, great. I just capitalized 2 years worth of costs. And by the way, it's millions of dollars. It's not
Right.
hundreds of thousands, it's millions.
Sure.
And so another situation where I reached into my pocket and paid for something and did not get a deduction, and therefore had to pay tax on the income that otherwise that expense would have sheltered. So you have some choices here. If you have costs that you capitalized and are amortizing due to the previous law, the act says, in essence, you have three choices. If you are a small taxpayer, which is a taxpayer defined as someone whose gross top line revenue is $31 million or less, and you have to do an average of the last 3 years. So you look at 3 years worth, take the average. If you're $31 million or less, you are considered a small taxpayer for this provision. If that is you, you have three choices. You can go back and amend your 23 and 22 returns and pick up those costs that you capitalized. And you can also amend 24 if you've already filed, or if not, just expense it when you file.
Sure.
Or, so that you can do that, or you can deduct all of it on your current year 25 return, meaning the one that you'll file in 26, or you can split it and deduct half in 25 and half in 26. So
Okay.
three options: amend and grab, deduct in 25, or deduct in 25 and 26. Now, if you're not a small taxpayer, if you're over that $31 million, that first option falls off. So
Okay.
then your only choices are deduct in 25 or deduct in 25 and 26.
Okay.
And there's a lot of consideration to go into those as you're looking
Sure.
at that. So that is one where we would strongly encourage your audience to reach out to their tax advisors or call us here at CLA, and we would be happy to walk through those scenarios. There's some intricacies in there where, if you amend, and if you also took the research and development credit in those prior years, which most people would have, you're going to lose part of the credit. So it
Okay.
may not be smart to amend. It may be better to go prospectively and take those deductions as opposed to
Yeah.
amending.
Well, and to put it in reference for as far as the R&D credits have been in the past, maybe you correct me if I'm wrong with this change, but I think a lot of my listeners probably think that when you hear R&D, you're thinking lab coats and some pretty high tech stuff. And in a machine shop environment, for example, what's always qualified in the past for R&D credits is every time I get a new job that we've never run this part before, and we got to
Yep.
figure out how we're going to run it. We got to figure out how we're going to hold it in the machine. We got to figure out how we're going to program the machine to cut the metal to end up with the part that we need. We got to figure out anything related to that part. That was all.
That's
That
right.
all qualified for R&D tax credits. Well, all of us do everything I just described, right?
Yeah.
So if you have a prototype shop, that may be all they do. If you have a production shop, maybe you only do it a couple times a year, but you're still doing those things. And we all know the costs are very high to that. Anything changed that what qualifies as an R&D from that regard?
No changes for what qualifies. No.
Okay.
What you're explaining there is improving the process, right? There's two
Right.
parts. There's improving the product or improving the process. And like you said, that's one that some people, overlook is improving the process.
What's up, guys? It's Nick from Making Chips. You know my good friend, my co-host, my partner, Mike Payne? I'm going to give you 3 reasons why you should check out By the Numbers, the new podcast hosted by him. First, Mike is full of wisdom and experience for what it takes to buy, sell, and lead a business. If you look at his entire history, he's done it over and over and over again with lots of success. So he knows all about how to dive into the numbers that will improve your performance. Second, Mike's the first person I call. I call Mike when I have a new opportunity to acquire a business, explore a new partnership, or when I just have data I need to dig through and really understand what's going to impact the performance of my business. And third, you got to love the Tulsa King, the buttery voice that just soothes your soul and gives you the confidence to take that next step in your leadership. Look, if you love making chips, you're going to love By the Numbers. If you want to improve the financial performance of your business, and who doesn't, you should check out By the Numbers by Mike Payne under the Making Chips Network.
Yeah, I think I know I've been involved in many discussions over the years about the R&D tax credits, and it's always there just always seems to be quite a shock that what we consider to be our everyday process we do, when you really drill in on that definition of it, it's like, well, that's what we do. That is all R&D. And then they start doing the math in their head like, oh my gosh, even a small shop might spend hundreds and hundreds of thousands of dollars a year.
Yep.
That qualifies.
And over the past 3 years, since this 174 has been in place, a lot of companies, manufacturers have decided maybe not to be as aggressive on the R&D, right? Because before that, in 2021 and previous years, you were getting the R&D credit. It was just a benefit. But then once 174 was put in place, you still got the same credit, but now you have this requirement to capitalize the cost, which was really tough on cash flow for the smaller manufacturers. So maybe they weren't as aggressive. You still had the requirement to capitalize those costs, even if you didn't take the credit. But you could maybe not be as aggressive. So with this going away, the 174 going away, we're kind of back to trying to maximize that R&D credit because there is no capitalization of those costs anymore.
Yeah, I think that's one I would definitely encourage the listeners to look at, because a lot of people I talk to, they have not been taking advantage of that. Again, some of it's the mindset of, well, I don't have anybody in lab coats doing research, so they've never even looked at it. But it's a big credit sitting on the table,
right?
I mean, again, you could have a 2 or 3 person, a very small, could be yourself. You could be the only employee, and you're doing all the R&D yourself, and half of your time is going towards that, all that programming and fixturing and all that. So.
Right. We have a R&D team within CLA that does all that work. So we're able to provide that seamless service, right?
Yeah. There's a lot of your ERP systems, and the one we use certainly does. I mean, you can categorize all that work for R&D too. So I can almost just like in my pro shop, I can almost just kind of one click run a report of, here's everything that was R&D. Here's all the hours and expenses that went into those functions this past year, and then I can give it to the professionals to look at.
Absolutely.
And that's one reason why sometimes our clients maybe want to avoid that time that it takes to try to track that, and they don't realize everything that could qualify for the R&D. So it's definitely worth the time, to bring someone in to look at those costs, and that time that it takes you to gather that information. If your ERP system isn't tracking it, it may definitely be worth the time based upon the savings.
Is it still true though, even on that topic? And I know we're not here to just talk about R&D, but so in a general sense, let's say I have a full-time programmer, which I've got a couple, right? That's all they do is program new jobs. I mean, even if I'm not tracking it down to the hours like we do, can't I say 90% of that programmer's time is R&D?
Yep, that will usually work. Yep.
Yeah, So again, even if you were a one-person shop and you're doing all that work yourself, you can say, okay, a third of my time is spent on that, and that would qualify, correct?
Yes.
In most cases.
In most cases, yeah. And one thing I'll just point out, which I'm guessing a number of your listeners know, but we're talking about a credit here, not a deduction.
Right.
Whereas, so if it's a deduction and I spend $100 and I'm in the highest tax rate, I save $37 because I'm taking $100 off of my income. And therefore, I'm saving the tax rate on that of 37 cents per dollar. Whereas with a credit, it is a dollar for dollar saving. So if I have $100 credit, my entire tax liability goes down by $100. So instead of saving $37, I'm saving $100. So it's a pretty powerful item and something that is most certainly worth looking at, and especially with the requirement to capitalize those costs, a thing of the past.
Yeah,
Assuming it's stateside. It's got to be stateside.
Right. It's a gift card to the IRS.
It's a gift card. Yep. They don't give us many of those, so grab it.
No, they don't. Yeah. When it shows up, you need to use it.
Yes.
Okay, so we've tackled a few there. What else we got going on in this bill?
So I was going to cover the interest expense limitation under 163J, which is another big item that I think is going to affect manufacturers. So it tends to affect those that have high interest expense and maybe the income isn't quite as high, because under 163J, there's a calculation that's done to determine how much interest expense you could deduct. And that calculation is they take your taxable income, add back the interest expense, and then multiply that by 30%. And that's how much interest you're allowed to deduct. And before, I don't remember the exact year, I think it was about 2 years ago that they took away the ability to also add back depreciation and amortization. So it used to be you take your income, add back depreciation, amortization, and interest expense. Well, under this new bill, that is back. So in 2025, you can now add back depreciation and amortization, which increases that number that's applied against the 30%.
Okay.
So for our manufacturing clients and all clients, we can that number of allowed interest expense is going to be higher than it was before 2025.
And that could be really key. I mean, looking at how capital intensive this industry is, right? You've got millions of dollars worth of machines on your floor. Most people are financing that to some degree. So, I mean, interest expense is going to be high. So, so that window just opened up quite a bit.
Mm-hmm.
It did for those that have high depreciation amortization amounts. Now that's a benefit. There is one detriment related to this category, is there was a stance that we were able to take where we would capitalize some of that interest. So instead of expensing the interest, we would capitalize it into inventory. And then as the inventory turned, we would get the deduction through our cost of goods sold. And then that reduced the amount of interest expense we had because we were deducting it through cost of goods sold. And that was really, even if our clients had this interest expense limitation, we were still able to deduct it through the cost of goods sold. Under this new bill, it takes that strategy away because it says now you have to apply the 163J interest expense limitation first before you capitalize the interest. Now that doesn't take effect until after 12/31/25, so it's really in 26 that takes effect. So for 2025, we still have the ability to capitalize that interest expense, and then in 26 that goes away. So we weren't using. I mean, I had a couple clients that were using that strategy. So you had to have interest expense limitation, you had to have inventory, that was turning quick. So it had to be a good scenario, for that to apply. But just to note, that does now go away in 26.
That goes away. Okay. What else we got?
One thing I'll throw out there, and Mike, correct me if I'm wrong, but my money says that most, if not all of your listeners, while they are probably business owners, they're also, correct me if I'm wrong, humans. Yeah?
As far as I know, there's a lot of robots in this industry, but I don't think any of them are listening.
They're not listening? Okay.
No.
So what that means is that whether
they might be.
They could be.
My phone is.
It's true. So, what that means is that we also have to look at the individual side of things when it comes to
Sure.
tax, because whether we're a business owner or whether we work at a manufacturing company or whatever, even if we're a C corporation and all that income is taxed inside that C corporation, all of us file our individual income tax returns, right?
Hope
So,
so.
and a lot, I hope so too. Now, and a number of us probably have flow through income from our business that comes to us, and the tax is paid on our individual return. Well, there are a few provisions here that actually take place on the individual return. So whether you're the business owner or not, these provisions will apply to you. I
Okay.
would say that the one that has gotten the most media attention is the deduction of state and local income tax. So that one has just absolutely been almost polarizing in the media as far as what's going to happen there. So if you go back again to that Tax Cuts and Jobs Act, which passed during Trump's first term, there was enacted in that act a limitation on the amount of state and local tax that you can deduct on your personal return.
Okay.
So the first thing is you have to itemize to deduct those taxes. So if you don't itemize, you can tune out for the next 2 minutes.
Okay.
But what happened is there was a limit put on that you can only deduct up to $10,000 of state income or real estate taxes or city taxes. So for example, I live in Texas, and in Texas, we don't have an individual income tax, but we do have really, really high real estate taxes. And so in Texas, we deduct real estate tax. Now,
Sure.
our business owners, they may pay tax in a number of states, and they also have real estate tax. So all of that becomes deductibles and itemized deduction, but it was limited to $10,000. So OBABA has increased that limit to $40,000. So
Okay.
a $30,000 increase in deduction, which will save you about maybe $10,000 in tax. So it's not nothing. But we have to be careful because there is a phase out. So if you make over $500,000 in a year, the phase out starts. And if you make $600,000, then you're only limited again to deducting $10,000. So
Okay.
from $500,000 to $600,000 of adjusted gross income, your deduction becomes limited from $40,000 back down to $10,000. It never goes below $10,000. And that is a place to do planning, because if you're not using your full $40,000 deduction, you may live in a state where you can double pay on your real estate taxes. Like, let's say this year I'm going to be at $485,000 of income. So I could use the full deduction of $40,000, but let's say my real estate taxes are only, I say only, you can tell I live in Texas, are $15,000. What I can do is double pay that this year if I want to, and bump that up to $30,000 in 1 year. Plus, maybe I have some like maybe I pay a little bit of Oklahoma tax or some other state where I could also deduct that too. So it is something to do a little bit of planning around, or at least think through.
Yeah, that's an excellent point. I did not follow that part prior to you just explaining it, but that's good to know because, I can see a lot of options there.
Yeah, there really are. We call that bunching your itemized deductions when you double pay something. So it's a pretty good little provision. Now, if you have an entity and it's paying a whole lot of state tax in a whole bunch of different states, we had these elections in prior years where you could elect to have that state tax deducted by the entity instead of deducted at your individual level.
Okay.
And as the bill was bouncing back and forth between the Senate and the House, there was discussion about eliminating that opportunity. Thank goodness it was not eliminated. So we still have that. Plus, we have the enhanced personal deduction for taxes as well.
Go ahead and explain that one real quick too.
Which one? The
enhanced personal.
Oh, yes. That is the enhanced personal is the deduction going from
okay.
2,000 to
Okay.
40.
I got you. I'm with you.
Exactly.
Okay.
Yeah, so that deduction, I'm in California, so that deduction of deducting the state taxes through the entity, right? So S Corp partnership is huge out here in California with the tax rates that we have. So the way that works, and for the listeners, hopefully they're taking advantage of that currently. But the way that works is the company makes the payment, and for California, you can make up to 9.3% of the required payment. So if you have $1 million of California taxable income, then the entity can pay $93,000 in tax and then deduct it on the federal return, and then the taxpayer receives a credit for that $93,000 to be used on their personal. So keeping that in place was huge
That's
because, as
a
Susan
huge
said,
win.
there was talk that they were going to take that away, but it just basically free money when this cap was in place. The cap is larger now, but for those manufacturing clients that still have million, 2 million of income, they're going to be over that 40,000. So this pass-through entity tax, we call it PTET, is still in place and should still be utilized, even though this salt cap has been increased to 40,000.
Okay. Yeah. So that's one. What I would tell the listeners, I mean, that's one you definitely want to talk with your advisors about, or call Susan and Steve and work through that in your individual situation, because it's going to vary
That's right.
every state and local jurisdiction you're in, right? I mean,
And the requirements
whether your county taxes,
Yep.
your everything.
Everything.
and the requirements to participate in those is going to differ by state. In California, you need to make the first 50% payment by June 15th of the current year. So you definitely want to talk to your advisor to make sure that you don't miss a deadline to participate in that benefit.
Yeah, for sure. Okay. Well, so that's a good one. What else we got going on?
So the one thing to note is they enhance the advanced manufacturing credit. So the manufacturing credit was 20%, and that's been increased to 35%. So that's for property placed in service after 12/31/25. So basically
Okay.
for 2026. That was created first in 2022, and it's with respect to manufacturing facility or eligible taxpayer. So the primary focus was for those manufacturing semiconductors or semiconductor manufacturing equipment.
Okay.
So just want to note that it's the only thing that's changing, it's increasing from 20 to 35%. So for those
That's a big jump.
manufacturing clients that were benefiting from that, it'll be even a larger benefit.
Yeah. Okay. Yeah, that could be a huge jump for some people. And I know, I don't know what all qualifies for that, but just based on what you said, I know a handful of our listeners that are in the semiconductor space, so I assume it probably ties all around that industry, right? So you might hear that and think, oh, that doesn't apply to me, but the few people that popped in my head as soon as you said that, I think it absolutely would apply to them. So people should look into it and see if they would qualify for sure.
And I'll touch on one more. Now, what I'm about to talk about is really, Mike, it's really going to be limited mainly to your C Corporation listeners, those that have chosen to be taxed as a C Corp.
Sure.
And so I won't spend a lot of time because I don't know the population that might apply to. But what I do want to say is there's been a lot of noise that an opportunity to buy a credit to offset your tax evaporated with this act. And that is not true. It does have a shorter life now, but it did not evaporate or go away yet. So let me explain. If you are a C corporation, if you operate in a C corporation, and so that entity itself is going to pay the tax, you have an opportunity, if you so choose, to buy a tax credit. You can buy it, and you would pay, let's say, 90 cents on the dollar, therefore reducing your tax in essence by 10%. So if you're a C Corp and you pay 21%, if you buy it, you could save, and this really works well for great big tax liabilities. We would say tax liabilities of $2 million or more. And we've had clients who pay $150 million in tax, and this is a huge win for them. So if you are in a C corporation environment and you think you're going to have a significant amount of tax due, either for 24 or 25, please, please, please reach out, because we can save you millions potentially by
Sure.
buying a credit. So I just wanted to clear up that is still an opportunity. It will start evaporating 26, 27, 28, but right now we still have it.
When you talk about these credits, so I have a pretty thorough background in tax credits, state and national. Are you talking about, I mean, it could be a film credit, a historic building credit, a new
It's
energy credit,
specific.
all those types of things, or are you talking about something else?
They're different. So these
Okay.
came in under the Biden administration to encourage green energy research, infusion, structure, all of that. So companies that are, if you can imagine building, say, a wind farm.
Sure.
If you're building a wind farm, think of all that upfront cost and how expensive that is. You are not going to be operating in an income position for quite some time. So those companies are generating losses in essence. And so they take the value of those losses and call it a tax credit.
Mhm.
And so they are not going to use that loss. They don't have income. They won't have income for a while. And so you can buy that loss or that credit and use it on your for-profit manufacturing entity to offset. So the trick is you have to buy credits that qualify. So you've got to work with a firm that has a department or the expertise to do that. And then you get insurance around it. You get credit solidification insurance, all that. So that basically, and the seller pays for that. So the buyer doesn't really come out of pocket. So, and what that does is when I buy the credit from, say, that solar farm or that wind farm, I'm giving that green energy company more money for them to use to build out more green energy.
Right.
So that's the
Yeah.
incentive.
Okay. So that's the structure I'm familiar with.
Yep.
There's so many categories, and there's a lot of state ones and all
That's
that.
it.
And we talked, listeners, you might want to go back to, and maybe we can find it in the show notes, but if you go back to probably January timeframe, we did a by the numbers on kind of, how to leverage credits and grants and so forth. It's just kind of just money and credits that are just sitting out there, and a lot of them go unused. Because people don't know about them, not so much because, it's not something people know about. I've done a lot with like solar credits and some historic building credits and stuff like that. New market tax credits back when that was, I guess that the new market tax credits are gone, right?
I think they actually got another breath of air in this act. Is that right, Steve? Do you remember, Steve? I believe they did.
Yes, I believe so also.
Yeah, but I mean, so good point bringing that up, because that's something I think a lot of people don't know about. Again, it's one of those things too, you're not going to do on your own. You need to call Susan, Steve, your advisor, whatever, and talk to them about credits that are out there. You got to find access to credits if you're wanting to buy credits. They get wrapped up pretty quick, pretty tight by banks and other large financial institutions to get those to your people that owe $150,000 or $150 million in tax. But you can get them personally too. You just got to find them. So
that's it.
The new market tax credit was made permanent.
Oh, good. Okay. For some reason, I thought that was gone. Let's circle back just a minute. So if we look at this industry, it's going through a pretty massive turnover. You've got, a lot of people looking to sell their businesses and transition and ownership to either, whether it's within a family or, whoever. There's a lot of investor interest in the industry now. So what things kind of came up in the act that if I'm thinking of selling in the next 3 to 5 years, whatever, maybe I should be taking into consideration from an estate planning standpoint?
So a couple of things from estate planning. The good news is the lifetime estate exemption was increased to $15 million. That's effective in 2026, and then it'll be indexed for inflation each year. So it was set to the sunset. The thought was maybe it goes to around $5 million perhaps for this estate exemption. So with that now that at $15 million, there is some planning opportunity there for potentially some gifting. But that's one thing that's really good news. And then one other thing related to potential sale of a business, indirectly related, is opportunity zone funds. So if you have gain from the
Okay.
sale of your business, right? People, a lot of, our clients, they have gain sell the business or from, other sources, but they've now made that opportunity zone permanent and have created a plan to renew it every 10 years. So there's like a rolling 10-year plan because the old policy was set to expire. And what happens is let me take a step back and kind of explain how it works. So when you have gain, you can put the gain into an opportunity zone fund to defer the gain.
Okay.
And in the old policy, you can defer the gain through, I believe it was 2026. So as we got closer to 2026, it didn't make as much sense to invest because you're only deferring the gain for a couple years.
Sure.
But now with this new plan, it's going to be a rolling 10-year policy, and you have 5 years before you need to realize that gain. And if you hold the investment in the fund for that 5 years, you get a 10% increase to your basis. So you would
Okay.
avoid paying tax on 10% of the amount you invested. And the good
Okay.
thing with the Opportunity Zone Fund is you only need to invest the amount of your gain. So for those familiar with a 1031 exchange related to real estate, you need to invest all the proceeds. But with this Opportunity Zone Fund, it's just the gain. You sell for $10 million, have a $2 million gain. You only need to invest $2 million to fully defer that gain for that 5-year period.
Okay.
So I think the main note is the Opportunity Zone funds have been extended, and there's gonna be a little bit of change to it, and it's gonna, I think, be a very good option for those that are selling a business and have gain that they don't want to pay tax on. Which,
right.
who wants to pay tax on their gain, right?
Right. Well, I mean, yeah. Or who doesn't want to defer it at least, right?
Right.
Okay, so as we start to wrap up, we talked about several key topics there. Let's talk about some kind of step-by-step advice of, so what would you guys say is the lowest hanging fruit of stuff that I'm in the middle of the year. I have, obviously I've already done things for half the year. I've got the rest of the year to go. What's some low-hanging fruit that I need to just right now make sure that I'm ready to take advantage of some of these changes?
I would start, if I had to capitalize research and development costs, I would start there because that is going to be a huge deduction and something around which we need to make a choice somewhat soon as to how we want to recapture those costs that were capitalized historically. I think that's one. Another one that I think is pretty time sensitive or could be time sensitive is looking at time sensitive. Well, it needs attention, and that is the depreciation provisions around doing a cost segregation study on a building or buying a new piece of equipment. Those things, I think, also have the ability to move the needle somewhat substantially as it pertains to your tax liability.
Well, and on that point, I mean, let's just use a piece of $300,000 equipment as an example again. I think most people that are maybe shopping for equipment right now, I mean, you're seeing very seldom are you buying that piece of equipment that's going to be here next week.
That's right.
I mean, you're 2, 3, 4, 6 months out. Well, 6 months out, I'm in 26.
Right.
From today. So if that is part of your strategy, you need to start talking to those people today.
You do.
So that you are going to take advantage of it this year. And then certainly a cost seg study. I'm sure you're looking at 3, 4, 5, 6 months to get that accomplished as well, correct?
It could be
at least a couple of months,
a month or 6 weeks or maybe 2 months. But yes, it's something that you'd want to address and also be strategic about what year you do it in.
Yeah.
So yes, and if you haven't filed your 24 return, well, I guess no, that's not true. Darn. Yeah, it'd have to be on the 25 return. But I do think it's something to once again start thinking about and looking at.
Yeah, you don't want to call the first week of December on that, I say.
Right.
Right. Probably a little busy.
But one other reason to look at this right away and reach out to your advisor is because you're making 2025 quarterly estimates currently,
Yep.
right?
Sure.
So you're also maybe filing your 2024 return, have an overpayment, and trying to decide, do I refund that or do I apply that to 2025? I just finished up a return last week for a client that does have the 174 costs, unamortized costs that they're going to deduct. and they're not a small business taxpayer, so we need to deduct them in 25. And because we have that large deduction, we decided to refund the whole overpayment and not have to make a third quarter estimate. We're going to
Okay.
revisit it in the fourth quarter, but it was good timing that this bill was passed right as we're completing the returns, because we were able to get them, hundreds of thousands of dollars of refunds that we were anticipating applying to the 2025 for estimates that now we don't need to.
Yeah, sure. Makes sense. Yeah. Okay. So any other low hanging fruit there that you still have time to do this year?
I would look at your tax deduction on your personal return, your SALT deduction, do a little bit of planning there. Estate planning, it may be time, especially if you think you're going to sell your business, maybe time to start some of those conversations as well.
Sure. Well, the biggest thing I would tell everybody is, talk to your CPA, talk to your advisors, call Susan, call Steve. I don't think, I feel I'm pretty well versed in a lot of this stuff, and I wouldn't go alone on this. There's too many variables. And in my experience, I think I'm going to take advantage of this. It might totally get me over here though. Right. There's going to be trade-offs. I think as you pointed earlier to Susan, so much of tax strategy, it's, as you said, it's not evasion, right? It's avoidance. And in most cases, it's not even avoidance as much as it's deferral, right?
That's right.
So are you just pushing some huge liability to the future? Potentially. Even as we talk about, okay, I want to sell my business in 3 years. So I'm making all this capital investment now, which that's a whole nother discussion. But, if I take all that bonus depreciation this year, I'm just going to pay gains on it in 2 years when I sell, right? So there's a lot of things at all points of this process that you need to be talking about with people like you guys.
Absolutely. It's what we're here for.
Short-term and long-term plans.
Absolutely.
How about just a brief, from each of you? And I kind of hate to put you on the spot, but I'm also anxious to hear your answer. Overall opinion of the One Big Beautiful Bill. How beautiful is it?
I'll start. For manufacturers, I think it's very beautiful.
Good.
Between the 174 going away with those capitalized R&D costs, with 163J interest, which I talked about before, that we now can add back depreciation and amortization, and with the 100% bonus depreciation, I think just those three items alone, I think, make it beautiful for manufacturers.
Okay.
There aren't many detriments. A lot of things were made permanent, so I think it's big. The discussion is the cost of it, right? Which, yeah, there is a cost, and it's to be seen on what that impact is.
Sure.
But for our manufacturing clients, it definitely is beautiful.
Yeah. Susan, what do you think?
Yeah, I should have gone first because
He steal your answer.
I couldn't agree more. It is definitely one big, beautiful bill act.
Yeah.
And especially for your audience, it's definitely, there's a whole lot more good news than there is bad. There's a little bad news sprinkled in here and there, but certainly the good news will overcome all of that.
Yeah. I don't want to end this on a downer, but what are a couple of the things that people really should pay attention to that could be detrimental to them? Anything stick out in your head, personally or manufacturing?
Yeah, there's a new limitation on itemized deductions now. It's somewhat small, but just on overall itemized deductions now, we had a limitation before that. It was called the Pease limitation. It was named after a congressperson with the last name Pease. That one went away. We now have a new one. So if you're considered a high income taxpayer, that may be a limitation that's bad. We also have a charitable contribution deduction limitation that we've not yet talked about. And that's a little bit of a haircut. It's very, very small. It's 0.5% of your adjusted gross income is non-deductible for charitable contributions. So you have to get over that hurdle before those contributions become deductible. So that's a couple of things where it's a small haircut, but again, the other things that we have in place, like the SALT deduction, and like all the things that Steve just mentioned, the interest expense deduction, all those should overcome.
Steve, anything different stick out to you that people need to worry about?
The big one is the energy credits. right? So there's a lot of those credits that are phasing out a lot quicker than they were supposed to, right? So for instance, the solar credits, for residential, that's phasing out, at the end of this year. The EV vehicle credits, those are, I think it's September 30th of this year. Those will be gone. So, and there's a lot of other credits that are probably a little less known, but that
Yeah.
are phasing out a lot quicker also. So I think that's probably the biggest one that I can think of.
Okay. But overall, the gains are outweighing the losses for sure.
Definitely.
It sounds like, yeah. Well, I know, I know the way I kind of run my businesses, and I typically will tell others is, you need to run your business that's good for your business. And yes, you want to be, tax efficient and smart, but you can't let those things dictate your business. Again, it's avoidance, it's deferral, it's efficient, right? But you still have to do smart things. And I think, this might change my opinion a little bit. There's a lot in this bill that you do need to like really take advantage of, and look at how does this play into either it's my growth or my exit plan, whatever that might be. There's a lot of changes that people need to be paying attention to. And I think this was a great conversation to start that. And, yeah, I would encourage listeners to absolutely, reach out to Susan and Steve. How would they get a hold of you if they have some questions? What's the easiest way?
Sure. They can email us. My email is susan.roberts@claconnect.com. And Steve's is steve.combs, also at claconnect.com. That may be the easiest way to get a hold of us.
Sure.
Or jump onto our website, and it's claconnect.com. And there's places there where you can send a message through, and it'll get to us that way too.
Yeah, and I would encourage everybody to go check out their website anyway. There's some great resources on there all the time for manufacturers. There's a whole manufacturing section with lots of great content that they've put out. I think you guys, I don't even know how many like webinars and stuff you guys must host as a firm, but it seems like, probably daily there's a half dozen of them. And a lot of those are focused on manufacturing. A lot of those are focused on business owners, regardless if you're in manufacturing or not. And, I know I've gotten a lot of value out of them, and I would certainly encourage the listeners to go check those out and find those. I follow you guys a lot on some of your social media platforms, certainly LinkedIn. You're very, very active there with a lot of content out and publishing out the webinars and how to register for them and all that type of stuff. So yeah, people should go follow that. You guys,
Absolutely.
you guys put a lot of really good information out in the market. So
thank you so much. And thank you for having us.
Yeah,
yes,
this
appreciate
was good.
it. Thanks for the invite, Mike.
Yeah, so we need to, so listeners, we're going to also follow up. I know Steve, I think we were all on an email the last couple of days. We're going to follow this up too with some written content that'll kind of go along with this, just kind of with some of the bullet points behind what we talked about today, and just try to give you all the resources you need. So with that, guys, we always close the show the same way, and I won't expect you to know it, so I'll just handle it. But yeah, if you're not making chips, you're not making money. Bam.